All right, I have 1 o'clock Central Time, so let's get started. Thank you again for joining Pinnacle's webinar on Health and Wealth Strategies, how to incorporate HSAs and 401ks into your business and personal retirement planning. My name is Mary Wettstein. I'm an associate here at Pinnacle Financial Partners and a senior vice president on the Health and Benefits team. A couple of housekeeping things before we begin. We muted everyone when you joined the call today to make sure everyone has a good audio experience. We will save time at the end of the presentation to answer any questions you may have. If you'd like to submit a question or need further clarification, please send it using the Q&A or chat function on the right-hand side of the WebEx screen. We will capture your questions and try to answer as many of them as we can. The session is being recorded, and you will receive a link to the recording in a follow-up email. We've had a number of employers ask if they can share the recording with their employees, and yes, you absolutely can. Our presentation has been approved for continuing education credits for HR professional designations. A certificate of completion along with the activity code will be mailed to participants attending the live event. All right, one final housekeeping note to keep our compliance folks happy. The information we provide to you today may change tomorrow, especially given the urgency in which the IRS, Department of Labor, and Congress are passing legislation in the wake of COVID-19. This is what we know to be true as of today. Information provided is for educational purposes only. We are not providing specific legal, tax, financial, or medical advice. Please consult your legal counsel or your tax advisor for your particular circumstance. So a little bit about Pinnacle Financial Partners and why we're so passionate about the topic today. Pinnacle was founded just over 20 years ago and is now a top 50 bank with clients nationwide. It was built upon the premise clients want to be treated with respect by someone who knows and understands their personal and business needs. To that end, Pinnacle established a broad range of services that uniquely position it to provide comprehensive financial solutions. Our goal today is to bring together experts in 3 of those areas: health and benefit administration, such as HSAs, retirement plans, such as 401k, 403b, and individual wealth planning, in the hope we can shed light on the important connection and how these 3 areas work together to maximize your overall financial strategy. The correlation between health and financial well-being has never been stronger. Employers are moving toward education and resources that go beyond traditional benefit offerings. Financial education is becoming a recognized benefit in high demand as employees look to their employers to meet this need. Today, we're going to talk about how key benefits can positively impact individual retirement readiness and an organization's bottom line. We'll provide a quick review of HSAs, followed by our retirement plan experts, and we'll tie everything together with the Pinnacle Asset Management team. So a quick review of HSAs. Health savings accounts are a tax-advantaged medical savings account for individuals that are covered by a qualified plan. Annual contribution limits are set by the IRS, and you have until tax day of the following year to complete your maximum contribution. This year, the IRS gave you an extra month, so you have until May 17th to make your 2020 final contributions. We're going to share today some of the reasons why HSAs should be considered a lifetime account and not just one to pay for short-term medical expenses. HSAs are a great enhancement to your retirement strategy and the most tax-efficient way to address retirement and health savings. We recognize not all HSA account holders have the ability to adopt this strategy. I have 4 children and was definitely a spender of my HSA dollars for a long time. But for those that may not have a lot of medical expenses or can contribute the maximum amount, we present a different perspective on ways to view your HSA. One of the primary benefits of HSAs is that they have 3 tax advantages. There is no other savings vehicle that offers this, which is why we love them as a long-term strategy. Generally, contributions are not taxed. Earnings are not taxed, and distributions from the account, if made for medical expenses, are also not taxed. Pre-tax contributions are not subject to payroll taxes for the employer or the employee. Thus, the more your employees contribute, the less you pay in payroll taxes, and your employees realize an immediate savings on payroll taxes, plus any state or federal income taxes as well. HSA qualified medical expenses include a wide array of items, such as what you may think of as typical expenses, like prescriptions, dental, vision, clinics, hospitals, but it also includes a much broader list, such as over-the-counter medications, feminine care products, sunscreen, and most recently, personal protective equipment, such as masks and gloves. Key features of an HSA are your HSA is exactly that. It's yours. The money in your HSA account stays with you, even if you change jobs or insurance plans. Your HSA money is yours to withdraw and use at any time for eligible medical expenses. Even if you no longer qualify to contribute to an HSA, you never lose the funds in the account. It's yours until you spend the balance down to zero. When you turn 65, you can withdraw and use your HSA funds penalty-free for any reason. Withdrawals are subject to ordinary income tax if they're not used for qualified medical expenses, but there is no penalty. Some interesting facts about HSAs that account holders are often surprised to learn. If you pay for something out of pocket, you don't have to reimburse yourself in the year you incurred the expense. For example, if I use my personal debit card to pay for a medical expense, I can save that receipt and pay myself back with my HSA dollars at any time this year, next year, 5 years from now, or even in my retirement years. HSAs are governed by the IRS, and while the Affordable Care Act raised the age children can remain on their parents' health insurance, the IRS did not adjust HSA governance. So what happens is that you can't use your HSA dollars to pay for your adult children's medical expenses if they are no longer your tax dependent, even if they're on your health plan. These adult children, however, can open their own HSA account and contribute up to the family max, which is $7,200 this year, because they have family health coverage, which is what the IRS looks at when determining an individual's maximum. The parents can also continue to contribute up to the family max as well. Anyone can contribute to another person's HSA, parents, grandparents, friends, neighbors, employers, but only the account holder can claim the contributions for tax purposes. This is definitely something to think about from a strategic standpoint. If you name your spouse as the beneficiary, the account will retain its tax status and become your spouse's HSA with no estate or tax implication. Anyone other than the spouse's beneficiary, it will become part of your estate assets. And finally, HSA dollars can be used to pay for long-term care insurance. Annual limits are based on age. Later on in the presentation, James and John will cover some of these from a financial planning perspective as well. So we're excited to share our panelists with you. We have a great panel. Ginny DeBartolomé and John Emig, have extensive experience advising clients on retirement plans and fiduciary obligations as a plan sponsor. In addition to working with the employer, they also provide individual participant guidance. Following them will be John Webb and James Hundley, who will then share their perspective on incorporating both HSAs and 401ks into personal financial planning. They also provide individual and employer guidance. I encourage you to ask them questions. Again, you can submit those through the Q&A function on the WebEx. I know we can all learn from their breadth of experience. With that, I'm going to turn it over to John.
Thank you, Mary. As Mary said, I am John Emig, Senior Vice President and Manager of Pinnacle Retirement Plan Services teams. With me today is Ginny DeBartolomé, who is our Retirement Plan Specialist and Advisor in Tennessee. We are excited to be able to speak with you today about this topic. And I'm actually going to turn it over to Ginny first to kick off our retirement plan discussion. Ginny?
Well, thanks, John. I also am excited to be with everyone today. And before we go into the specifics of an effective retirement plan package and benefits, I really wanted to share some data and statistics around the financial stress and why it is so critical to have a program in place that's going to help you as an individual and your employees combat this. Stress is not new news or surprising in this day and age. We are over a year into a historic global pandemic creating stress. We have social unrest, we have political unrest, so stress is there. That can cause tension and other complications. However, unfortunately, financial stress has been around for a minute, for a longer time. And this study is actually from PwC in 2019, so this is pre-COVID, and this study is showing you that 57% of employees indicate that there's some level of stress with a personal financial situation. And then 46% of employees state that the financial stress is greater than any other stress that they're currently experiencing. So just to put this into context for you, you at your company, that means 50% of your work base is experiencing some form of financial stress. And how this is going to impact you and your bottom line are several different ways. Stress can cause physical health ailment. Stress can make you sick. It's going to create tension, and it lowers patience, so relationship troubles, and then creates distractions in the workplace as well. So speaking through to the workplace, how this really will hit your bottom line is when employees are experiencing the financial stress that bleeds over to the workplace. And the prime example would be that higher insurance cost. So when employees become sick, they might use a higher health care plan or just utilize the health care insurance more. That's a higher cost to the employer. Additionally, if people don't feel ready to retire, they're going to stay in their current job longer. We are seeing more and more of our clients have a lot of workforce late into their 60s, some even early 70s. And the majority of the reason this is occurring is because they just don't feel ready to retire. So as a company, you're holding on to that employee base that it might be older and have either higher cost salaries or just prevent you from promoting someone from within. There could be a younger individual that is promoted into a position, but it's not available yet because, again, this aging population does not feel ready to retire. And from earlier stress, that also would indicate lost productivity due to either being out for sickness or just distraction. So the same example or the same survey earlier with PwC shows also that 30% of employees are distracted by finances at work. And 46% of those polled said that they are so distracted that they are spending 3 hours a week dealing with personal financial matters. So to put this into an example and context for you, if your company has 500 employees, 30% of those are distracted. So you have 150 employees who are distracted from financial stress. If 46% of those spend 3 hours a week at work, you can see how the math plays out. That equals over 10,000 hours a year for a distracted employee just stressed out about their financial situation. And if you just apply a wage a little less than $20, that's $200,000 to the bottom line that's just unproductive, that's not going towards your company's success and goal. And so these are all the costs from your company, but what I want to walk with you next through are just the expenses to expect in retirement. These should be no secret to anybody. These are the expenses that we are all experiencing day to day as an individuals. You're going to have your housing, transportation, food, health care, and utilities. Now with housing, as we consider retirement, many of us anticipate or at least hope to not have a mortgage. So we would feel like that would be a much lower number. However, in 2018, a retirement and mortgages survey by American Financing showed that 44% of Americans 60 to 70 currently have a mortgage, and 17% of those state that they will never be able to pay off the mortgage in their lifetime. So that is a true expense. Additionally, another 32% said that they would be paying their mortgage at least 8 to 10 years into retirement. So again, this is just an expense that they're going to have, that if you have a successful retirement plan and package, this will offset some of those expenses. Transportation kind of speaks for itself. That's your mode of operation, vehicle, gas insurance. Food, this is after retirement, it's $8,000. To me, that seems low. I'm in a household of 4 with 2 teenagers. I think that's what I spend almost each month. And then in healthcare, though, this is what Mary was alluding to. The healthcare costs in retirement are averaging about $7,000, and that's just for an individual. So if you are in retirement for 25 years, the simple math is that's $170,000 that an individual will need to cover healthcare costs in retirement. And typically you're in a household, you're going to have a spouse or a partner, and so that's $340,000 in retirement necessary just to stay healthy. So again, trying to reiterate that the HSA accounts is something that's for a lifetime and to save for retirement if you can, and not just the short-term use to pay for day-to-day things. So if you're able to create the HSA and utilize those dollars toward your retirement, you're still left with $44,000 of expenses annually that you need to cover. And there is Social Security and some other things out there to help combat that, but I think we all know having a healthy retirement plan is going to be the best way to provide for yourself in retirement. And one of the best ways to plan for successful retirement is to offer and participate in a 401k or corporate retirement plan. Companies offer retirement plans essentially for 3 purposes. These are the 3 R's. They're to recruit, retain, and reward. We all know that it is really important to have qualified people with your firm. So when you're out there and you're searching to have someone with a lot of talent or experience, it's typically a competitive market. There was a study from Willis Towers and Watson that said that 51% of employees join their current employer because it offers a retirement plan. And when these employees are considering your firm or company, if you show that you have built a benefits package, that will immediately give the company some credibility and show that they're there for the long-term success of the individual employees as well as the company. And sometimes if individuals are considering 2 different opportunities, having that stronger package really could be a tiebreaker and have you be able to obtain this top talent. Once you get the talent, you want to retain that talent. And so retention is another way that a benefits package really keeps employees feeling valuable in their position and speaks to another compelling reason where they remain on the job. So 75% of employees are saying that a strong employer match inside the retirement plan is one of the reasons that they remain just in their current job. So again, once you recruit that top talent, you're going to be able to retain it using these benefit packages. And then ideally, we all know the reward component. Retirement plans were built as another way to reward a company's employees when they have helped achieve their success goals. There's profit sharing plans. There are 401ks, simple IRAs, all different ways that you can create a retirement package and be able to give dollars back to your participants' pocket for retirement. And this survey actually from Glassdoor surprised me a little, but it said 80% of employees said they want benefits over a pay raise. And this is 90% when you talk to millennials. So when you have millennials, they're saying they don't just want an extra salary bump, they want the entire package. So this is just a critical example of the necessity of having a really strong benefits plan. Now, John, I'm going to turn it back to you, and you're going to talk about the specifics on an effective plan and then best practices for a plan and participant.
Thanks, Jenny. As Jenny said, hopefully your retirement plan is working to fulfill those 3 R's. Now, it's one thing to have the plan, but it really is another thing for that plan to be effective at helping employees reach their retirement savings goals. Most employees are going to need somewhere between 80% and honestly 100% of their pre-retirement income once they reach retirement in order to maintain the same standard of living. Jenny talked about, the number of people that were going to still have a mortgage in retirement, and that 80% replacement number really assumes that you don't have a mortgage. So it really could be that 80 to 100%. You may almost need to have as much income when you retire as when you were working, depending on how your bills are. At Pinnacle, we believe that one of the best ways to track successful plans and effectiveness of retirement plans is looking at the percentage of your employees who are on track to reach that income replacement goal. Oftentimes when I sit down with a client or a prospective client, one of the first things I ask is, tell me about your plan. Do you have a successful plan? And often they say yes, that we've got a really good participation rate. Maybe, it's around 85%, and that's really, really good compared to the national average of 76. But what if the average contribution rate of that employee group was only 3% of salary? I think we can agree that most employees aren't going to be able to save just 3% of their salary and be able to retire. Even if they have a dollar-for-dollar match that takes it up to 6%, it's still not going to get them to the amount we need to be saving. Industry recommendations have been that employees need to be saving somewhere between 10 and 15% of their salary every year. In a recent interview, the head of participant strategy and development at Vanguard was saying they're actually now suggesting a 12 to 15% contribution rate. Again, a combination of both employee contributions and the employer contributions in order to reach that 80% replacement income figure. At Pinnacle, we really try to help our plan sponsors look at those kind of things by providing reports and projections at both the plan and the individual participant level so we can identify who's on track to retire and who may need additional attention and assistance to reach that goal. So now we have some idea of what it might mean to be effective, but what factors can we change or add to make the plan more effective and more successful? First one I want to talk about is plan design. And really just the term that means, what are the options that we can choose inside of our plan to make the plan uniquely ours and make it work best for us as the employer and for our employees? And we're talking about what's the eligibility? How long does somebody have to work there before they're eligible to participate? Are there matching contributions? Are there other employer contributions? Does the plan allow loans? Does the plan have an automatic enrollment feature? Does it have an automatic contribution increase feature? There are a lot of items in the plan that you can include or exclude to make the plan fit your needs and benefit your employees. I kind of like to think about it like my house. My house was built 12 years ago. Recently, we added, did some renovations, updated a bathroom, gave it a new coat of paint. Our retirement plan needs that same kind of attention and renovation from time to time to make it effective. Let me give you an example. We've got a traditional 401k plan that matches 50% of employees' contributions on the first 6% they're willing to put in. So essentially, they put in 6, the employer gives them 3. The How America Saves study by Vanguard is telling us that in 2019, the average employee contribution across plans was 7%. So let's assume a 7% contribution rate. The employee puts in 7, this plan puts in 3, a total of 10% of salary. Now look, 10% is good. I'm not arguing that it's a bad number, but it doesn't reach that 12 to 15% that we were talking about that you need to reach your replacement income goal. So instead of that kind of plan design, maybe we tweak it and renovate it a little bit and say, we're going to have an auto enrollment plan where employees are automatically put in at 6% of their salary once they reach their eligibility. And that 6% increases 1% each year until the employee gets to 10% of salary going into the plan. Add on top of that the 3% matching contribution that we already had in the plan, and now the employee is at 13%. Again, that takes you right in line with the recommendations between 12 and 15% to reach your retirement replacement goal. And that little design renovation can really make a huge difference in outcomes for employees. So once your plan design is up to date, what do you do next? Well, we need to certainly educate our employees. Do you have a plan, for educating them, and do you update it? Many of you may be familiar with the investment policy statement for your retirement plan. That's the policy that governs what kind of funds you have, how you review the investments in your plan, and when you need to change an investment. Well, maybe we should look at implementing an education policy statement, which would outline the education provided to your employees, and it's a roadmap for who, what, when, and how your employees receive information about the retirement plan. Most of the time, our employees don't really give much adherence or much credence or look at many of the materials we give them about the plan. So it's important that we find a way to get them engaged about their retirement plan. I've been doing this for about 25 years, and I've found that the best way is in-person, face-to-face meetings. That's the most effective way for providing education. But honestly, most of the time, it's not very practical, especially if you have a larger organization. We're here in the 21st century, so there's many different ways to do it, whether it's virtually, in person, on demand, the internet, email, videos, whatever it is. We want to be providing something because ERISA really tells us that we have to be informing our employees about their retirement plan. But whatever you provide, make sure you're also reviewing that information and keeping it updated so that it's current and meaningful. Financial wellness, a comprehensive financial wellness program is also a great tool. Often retirement planning is not about what's necessarily just going to happen in retirement. It's about what's going on in our lives today. We talked about all the expenses that we're going to have in retirement, and we still have a lot of those, or we have more of those as we're working. You know, we've got the mortgage, we've got credit card bills. I've got 4 kids as well. One of them's in college, and 2 of them are in private school, so we pay a lot of expenses. And oftentimes, employees feel they can't afford to participate in a retirement plan. I just don't have enough money. But honestly, they can't afford not to. So a financial wellness program that's integrated with your retirement plan, your HSA, and your benefits package is a great way to help them learn better budgeting skills, how to avoid excessive credit card debt, et cetera, that they can then find the dollars in their paychecks to put towards retirement. Right now, the average retirement plan balance in the United States is just over $106,000. However, unfortunately, the median average is only $26,000. Nobody's going to retire on $26,000. But increasing financial literacy and financial wellness programs can help increase those numbers. And lastly, they're the right partnership. Finding the right partner is absolutely crucial. You want to be sure that you're working with a group or someone who specializes in retirement plans, because it's the best way to get the knowledge, expertise, and experience that you need to have an effective retirement plan. Plans are complex with lots of great benefits, but they also have some potential pitfalls if you're not careful. So you want to be sure to partner with professionals who understand all of that. So we talked some about the factors that your company can review to make the plan truly effective. So now I want to talk about what a plan participant can do to make themselves successful in reaching their retirement goal. 1, create an action plan. Retirement's expensive. We've already seen that. They need to be sure you're creating a retirement plan now, planning for retirement, not just the retirement plan, but plan for retirement now. Envision what you want your retirement to look like and how much it's going to cost to get there. Once you develop that plan, be sure to implement it, stick with it, making tweaks along the way as your risk tolerance and your time horizon changes. Next, take advantage of employer contributions. Make sure that every employee is contributing enough to at least receive the full matching contribution if the plan offers one. In 2021, employees under the age of 50 can contribute a maximum of $19,500 out of their paycheck. If you happen to be age 50 or older, you can actually contribute a maximum of $26,000. Those contributions reduce your taxable income if you make them on a pre-tax basis, and so it lowers your current taxation. Most employees aren't able to contribute that maximum amount, but we certainly want to encourage everyone to contribute at least up to the amount where they're making sure they get the full employer match and not leaving any money on the table. Number 3, keep your current and future tax situations in mind. Again, we don't know what the tax rates are going to be in the future, but considering potential tax situations can help you decide whether or not you want to contribute your contributions out of your paycheck on a pre-tax or on a Roth after-tax basis. Remember, those pre-tax contributions come out of your paycheck without federal or state income taxes being withheld, reducing your current income, taxable income. They go into the plan, they grow tax deferred, you take those dollars out at retirement and you pay regular income taxes on them at whatever tax bracket you're in at that point. The Roth contribution, if your plan allows for you to make those kind of contributions, are after-tax contributions that you do go ahead and pay federal and state income taxes on now, and the earnings on those contributions grow tax-free when you take the distribution at retirement. So, we don't know which is better for you. It all is going to depend on your tax situation, but if your plan offers both types, you can look at and try to project what you think might be best for you, or do a combination of both. Should always try to avoid taking withdrawals before retirement. We don't want to subject ourselves to taxation or penalties for taking money out prematurely. A lot of plans allow for hardship distributions or loans, but participants should think long and hard about this and only take advantage of those when it's absolutely necessary. We've talked a little bit about HSAs, so we certainly want to contribute to other types of accounts, such as an HSA or an IRA, outside of our retirement plan at our employer. Once you've maxed out your 401k or 403b contribution, or at least put in the maximum amount to get to the employer match, then think about contributing to these other accounts as well. Speaking of the HSA, let's invest those HSA dollars if possible. Right now, if you put money into the HSA or any investment that's in just a money market type account, it's going to make virtually nothing. But very similar to your retirement plan, you can invest that HSA balance and help it grow so that you have more dollars to spend on the medical expenses and or insurance premiums, before and during retirement. And lastly, Mary mentioned this earlier, but we have it on our best practices as well. Pay certain medical expenses out of pocket and leave those HSA balances alone so they can continue to grow. That way you will have more dollars in both the HSA and your retirement accounts to pay for items that Jenny talked about earlier in our presentation. To wrap up, we've got 5 quick best practices for plan sponsors. Create a retirement plan committee. These aren't required, but it is the best practice that will help the plan run more smoothly and help fiduciaries avoid litigation. This group provides oversight and documents decisions that are made regarding the plan. That documentation can certainly help answer any questions that might pop up months or even years later when somebody comes back to look at stuff you've done. We like to help our committee members understand their fiduciary obligations, and we do fiduciary education for the plan committee to help them understand what their duties are and help guide them along the entire process. Number 2 is determine goals for the plan. What is it we're trying to accomplish with a 401k plan? Is the plan there to recruit? Is it there to retain? Is it there to reward? Do we have a specific thing we're trying to accomplish? And that's some of the questions that the committee should be asking. Once you answer those questions, then look at how the plan is designed and figure out if that design is going to allow you to accomplish those goals. And if it's not, remember, those plan provisions aren't static. They can be changed. So some are easier to change than others, but take advantage of the flexibility that you have and make the plan work best for both the plan sponsor, the employer, and the employee. Educate and communicate. This benefit isn't going to do anybody good if the employee doesn't know about it. It's important for the employees to appreciate the benefit and for them to use it. As a plan sponsor, we want to be sure we're providing some type of investment education, helping employees understand how much they should be saving. What it comes down to is many employees don't know what they don't know. So we have to put that information out there, find a way to engage them and get them to take advantage of the resources that are given to them and help them understand and develop a better financial plan for themselves. Number 4, hire experts. ERISA, which is the law governing retirement plans, requires that fiduciaries of retirement plans meet the prudent expert standard. This is a higher level of responsibility than a typical account might require. But let me put it this way. So if you were a company that builds bridges, your expertise is building bridges and not in administering 401ks or making investment decisions about 401k plans. So you probably need to hire somebody that's expertise is around 401k or 403b or 457 or defined benefit, whatever type of retirement plan you have. Make sure you have those experts in place so that they can provide you the assistance you need. And then lastly, review. And then we're going to review it again. So we want to review the plan on a regular basis. Some items like the plan investments may need to be reviewed more often than some of the other items, but however often we do it, we need to make sure it's done and then document the review for your fiduciary file so that you can prove that you're working to meet your fiduciary obligations. And when I say review again, it's reviewing all things. It's not just the investments, but it is the plan design. It is benchmarking your fees. It is reviewing the investment education of the participant education you're giving. And it's reviewing those providers, those experts that you've hired. All those things change over time, so make sure you're reviewing them and doing your due diligence on all those aspects. I'm going to turn it over now to John Webb with Pinnacle Asset Management. He and his associate James Hunley are going to talk about the key considerations for individual retirement planning, among other things. So, John, take it away.
Awesome. Thank you. Hey, everyone. Thanks so much for taking time to join us today. We're excited to talk to you not only about Pinnacle Asset Management and the services that we offer, but also HSAs and how they tie into one's overall financial well-being. So just a quick introduction on us. I'm John Webb, and with us we also have James Hunley. A little background. Prior to joining Pinnacle Asset Management, I was with Goldman Sachs in New York working on the special purpose acquisition team. before returning to Vanderbilt to get my master's in finance. And James is a second-generation wealth management advisor who has worked in the business nearly 20 years. He has a certified financial planning designation and spends the greatest amount of his time working with clients on financial planning needs. We obviously wish we could be doing this in person with you, but hopefully we'll have that opportunity here in the near future. So one of the first things you might notice is we have both Pinnacle Asset Management and Raymond James as our logos. We're actually duly employed by both. Back in its founding in 2000, Pinnacle Asset Management realized that we weren't just competing with local banks, but rather, Goldman's out of New York and JP Morgan out of Atlanta and other big banks like that. So in order to scale the practice, Pinnacle Asset Management decided to partner with Raymond James based out of St. Pete. This gave us resources, products, and bandwidth to be able to compete for sophisticated individuals and families. Raymond James serves more as our back office, and it has been an incredibly fruitful partnership, both for us and we think it's been really beneficial for our clients as well. Just brief overview on the two. So Pinnacle is one of Raymond James' largest partners, housing just over $5.8 billion in assets, and a little on our team as well. So we now have 4 people on the team. Brock Kidd is the head of it, as well as one of the founders of Pinnacle Asset Management. He has over 25 years of experience in the business. We also have James and me, of course, and then lastly, we have Janine Nally, who serves as our practice manager. We currently have over $650 million of assets under management and are the largest team at Pinnacle, as well as one of the largest teams at Raymond James worldwide. Now, moving on a little bit to what we do. So big picture is we guide families and individuals through the holistic approach to the advisory process. We'll go into a little bit more detail on what that holistic approach looks like, but really our goal is to help successful families and individuals navigate their financial needs. Our primary value add comes on the investment side, as we really specialize in portfolio creation and management, as well as overall asset allocation. We parlay the teams and resources available to us at Raymond James with our team's experience and expertise to provide custom-built portfolio solutions that put clients in a great position to meet their financial goals. As part of our service, we also provide ongoing financial planning advice, which we will again touch on soon. So before we get started, I thought it'd be important to just review the different type of investment accounts that we primarily deal with. So there are really 5 main accounts that we run into on a day-to-day basis. Our primary focus surrounds traditional taxable accounts as well as IRA and retirement accounts. But we also help clients with 529s in order to better prepare for the ever-rising cost of education. Although 401k and HSAs are not necessarily under our control, as part of the holistic approach, we provide advice and portfolio reviews for all clients and accounts, including these. Upon retirement or job change, many clients choose to roll their 401ks over to us in the form of an IRA that we then help manage. Although we cannot provide as much value on the HSA front, we are always thrilled to see clients or prospects mention their HSAs, and you will soon see why. I'm going to pass it over to James for a few minutes here to kind of go further into that.
Thanks, John. Some important and often unknown considerations specific to HSAs that pertain to retirement planning that are worth noting. Some of these will feel redundant from things you've already heard, but that's because it's important and it's because it's ever relevant for everyone's financial planning needs. 65, the withdrawals can be used for Medicare Parts A, B, D, and Medicare HMO, but not Medigap policies. For married couples, age differences should be considered because in order to use HSA dollars towards Medicare premiums, you must be at least 65, so a younger spouse cannot use their HSA money for an older spouse's Medicare expenses unless said spouse attained age 65. Post 55, there's the ability to catch up contribution of $1,000 a year. There are not RMDs or required minimum distributions as with other non-Roth qualified retirement accounts. Rollovers are allowed up to an IRS max. It's important for people to have a strategy for withdrawing funds throughout retirement. Not just looking at what may be the most accessible or convenient bucket at the time. Plan ahead and understand how your resources are meant to work best for you. And while not without risk, investing HSA dollars is a great way to protect against inflation and the loss of purchasing power. People need to understand how everything they own can best work together to complement what it is they're trying to accomplish. Know what you're doing and why you're doing it is something we say a lot. And then moving on, when we talk about our taking our clients through the planning process, we start with data gathering. We always like seeing HSA accounts, like John said, included on their balance sheet because it shows that they have the option and have the appropriate vehicle in place. Once we've gathered all the quantitative data for clients, we start to cover what we call the qualitative data, which is uncovering what are the most important goals in their lives. On a scale of 1 to 10, ranking goals with 10 being the most important, we always tell our clients that retirement must be a 10 because if you can't afford to live comfortably in retirement, enjoying it's going to be difficult. That said, healthcare must be part of the conversation. Rarely does someone come to us and say, I have a goal of accounting for healthcare throughout my retirement and keeping up with the ever-growing inflation rate. Most everyone underestimates how big of a deal healthcare is in retirement. When we present to our clients, we discuss longevity risk, which is the risk of outliving your money. We base life expectancy on actuarial tables and analyze accordingly, which has people living into their young 90s now. And based on these tables, a person retiring at 65 could need their money to last as many as 30 years, and that's not taking in any estate goals into account yet. When we review the goals within a planning analysis, we explain the inflation components used for regular retirement living expense and then compare that to the healthcare expense. We grow that retirement living expense at a 2.2% a year in our analysis, while we grow the healthcare piece at 5.1% a year, accounting for inflation. So that's nearly 30 years that one has to plan for to be safe to manage longevity risk, while also accounting for a significant amount of inflation. And that's all before we start to talk about the risks of long-term care and how expensive that can be. It's important for people to understand how badly health care expenses can torpedo a household's ability to execute on the retirement they have envisioned. We strongly encourage our clients to not tap into their HSA accounts during the accumulation phase of their life unless truly necessary. They'll be glad they didn't and thank us later when retirement rolls around, especially if that need were to arise when there's no more earned income. To strip it all down, we like to tell people that they really only have 3 levers they can pull with retirement planning: save more, spend less, and work longer. So it only makes sense to us to save as much as you can for health care so you have what you need to spend later. And with that, I'm going to hand it back over to John.
Thanks, James. And again, some of this may be redundant, but like James said, it's really just because we want to hammer home the points. So to highlight the importance, we wanted to provide a few facts on HSAs. So first, HSA contributions reduce taxable income. Secondly, HSA contributions made through payroll are not subject to the 7.25% FICA tax. These 2 facts scratch the surface on the benefits of HSAs and how they can increase overall purchasing power. Furthermore, withdrawal of these funds for eligible expenses are tax-free. Where the growth potential really comes into play is HSA contributions can actually be invested and the earnings accumulate tax-free. These funds do not expire, so they can carry over year to year. Lastly, contributions can be changed at any time, meaning that if you're in need of cash one month, you can reduce your payments, but then if you're a little more flush another month, you can always add more to it. So the flexibility is really helpful, and to kind of reiterate the flexibility, you can also change up your investment strategy at any point as well. So it's always important to keep in mind as you navigate your HSA investments. Again, this is just scratching the surface on the benefits an HSA can provide, but you would really be surprised at how few people take advantage. Only 25% of HSA participants say they have money in their HSA to prepare for retirement. This just shows a massive underutilization by the general public. Even worse, only 7% of participants said they invest their funds. This can lead to potential loss of purchasing power, as many people are missing out on the long-term compounding growth that can occur. Really, the moral of the story is we encourage clients to utilize these accounts and make sure they are invested. Now, a few questions that we've always gotten in the past is confusing HSAs with 401ks and really IRAs as well. So since they do have some slight overlaps, we thought it'd be important just to provide a brief comparison with some of the basics. The first main difference is that with HSAs, all withdrawals are tax-free, assuming they are qualified. With 401ks and IRAs, withdrawals are taxed at ordinary income rates. Next, HSAs have no age restrictions attached to when you can take distributions, whereas 401ks and IRAs do not allow for penalty-free distributions until the individual reaches 59 and a half, though people can choose to take distributions earlier by paying taxes as well as a 10% penalty. Lastly, when it comes to withdrawals, with HSAs, they are only allowed to be used for qualified healthcare expenses or else they will be taxed. But once you meet the criteria for 401ks and IRAs, withdrawals can actually be taken for any reason. So that is where there's a little more flexibility on the 401k and IRA side. The last thing that we really wanted to touch on and that we've mentioned a few times is associated with the purchasing power. So we've mentioned the purchasing power associated with fully utilizing HSA accounts, but we wanted to provide a visual representation. 401ks and IRAs are also tax-saving vehicles, but not all accounts are the same, as you can see on this graph. Because HSAs are not subject to both the FICA and withdrawal taxes, they are able to grow faster and more effectively. As you see from the graph, there's roughly a 30% higher purchasing power associated with HSA savings. It really is a powerful tool, and even though you may not be using that in the near term, you will be using the healthcare expenses at some point in the future, so it's always best to utilize and maximize your money here. Now, this last slide that we have here is really just a summary. It's a little bit small, but it's going over all the tax savings accounts that we discussed, and so this is just a broad overview that discusses the differences, so it's for you to take a look at if you have time. We just want to say thank you again, and we love the opportunity to work with any of you and all of you. So if anybody has any questions or would like some guidance along these lines, please do not hesitate to reach out to us. Although we don't always manage 401ks and HSAs, we're happy to provide investment advice to clients in whatever form that may be. Now I'm going to pass it on to Mary to close us off.
All right, thank you, John. So I know we've covered a lot of ground today. A couple things just to, from an employer perspective that may help you in identifying education opportunities. One thing to look at if you offer HSAs is to look at a tiered balance report. Your administrator should be able to give you not specific account balances because they are owned by the employees. You'll never have access to that. But they should be able to give you a tiered balance report, which generally gives categories, balances less than 1,000, less than 2,000, and so on, and then balances over 10,000, over 20,000. It'll help you identify, do I need to spend time educating my employees on what an HSA is and how to maximize it? Do I need to make them aware that there are investment opportunities, that they have larger balances? Things like that can direct your education opportunities. John covered some of the things you may look for in a retirement plan. Are you happy with the participation rate, with the deferral rate? We're happy to talk to you about education opportunities for any of the things listed here. Again, if you have any questions for the panelists today, send them through the chat or the Q&A function, and we'll try to get to as many of those as we can. And just to reiterate, we do have another webinar coming up in our Health and Wealth Strategies series here, and it really brings home the financial wellness aspect. I know a lot of HR teams have this as an initiative for this year and always on their docket to bring this to their employees. So we dig a little bit further into some of those topics that John had discussed, such as budgeting and mortgages, first-time home buying, raising your credit score, things like that help your employees deal with what they're facing now, and then hope that that prepares them better for retirement. All right, let me get that centered here. We've got a couple questions here. I did want to put everyone's contact information up that spoke today in case you want to reach out to them personally, but let's get to some of the questions here. So the first question that I have is, can you explain a little bit more about the difference between pre-tax contributions and Roth contributions?
Mary, I guess this is John Emig. I guess I'll grab that one. excuse me. So as I explained briefly earlier, those pre-tax contributions are what we would refer to as traditional 401k. Most everybody that's ever participated in a 401k or a 403b type plan has probably had their money come out of their paycheck on a pre-tax contribution. You don't pay federal or state income taxes. You still pay, as John and James were talking about right at the end there, you're still paying payroll taxes, FICA, FUTA, SUTA, all those other things. You're still paying those taxes on it, but you are not paying federal or state, if that applies, income taxes on those contributions that are coming out. And again, the money goes into the plan, it grows tax deferred, and you pay taxes on those dollars when they come out at regular income tax rates, whatever tax bracket you're in at the time of distribution. The Roth 401k contribution, Roth's been around now about 15 years in 401k plans, and I guess about, last statistic I saw was 65 or 70% of plans are now offering Roth contributions, is an after-tax contribution to the plan. The benefit being that although you're paying federal and state income taxes on those dollars, the money grows tax deferred, and when you take distributions at retirement, assuming two things, you're at least 59.5 when you take the distribution, and the first dollar has been in the Roth account for at least 5 years, then you get to take those distributions tax-free. The earnings come out tax-free along with the dollars that you've already put in on an after-tax basis. So it's just a way of you deciding when and how you'd like to pay taxes on your contributions to the 401k plan. It only applies to the money coming out of your paycheck. All the dollars that the employer puts in would always go into your account on a pre-tax basis, though. I hope that helps.
Great. Yeah, thanks, John. Another question here. I have leftover money in my HSA account, but no longer enrolled in my company plan. Can I still put money in my HSA? Your HSA is yours. The only criteria to be able to contribute to an HSA is that you're covered by a high deductible health plan. So if you're no longer on your company's plan, but maybe you have you participate in your spouse's plan or you have an individual policy, as long as that is a qualified high deductible health plan, you can continue to contribute to your HSA. Again, that's the only criteria that you're covered by a high deductible health plan. Another question is, can an employer match HSA contributions? Yes, absolutely. I think the best way to get participation up with HSAs is to have an employer contribution. So you can certainly set your employer contribution to either match or to cover a certain percentage of what employees are contributing. So yes, absolutely, employers have the ability to do that. Here's another question. Can you elaborate on rollovers from an IRA to an HSA? So the IRS allows you to make a once-in-a-lifetime rollover from an IRA directly into an HSA, and that can't exceed what your maximum contribution is for that year. So if you have family coverage, the amount this year is $7,200 that you can contribute to your HSA. You can take that money out of an IRA and put that directly rolled over into an HSA. Again, you can do that once in your lifetime. If your employer contributes to your HSA, you'd have to take that into consideration too, because all contributions can't exceed the IRS maximum. And sometimes we get the question as to why would someone want to do that? If you're faced with high medical expenses and you're looking at making a withdrawal from your IRA or a loan from your 401k to pay for those medical expenses, you could make that one-time transfer from an IRA into your HSA, and you can spend that for medical expenses with no tax consequences. So that's something to consider if you need funds to pay for medical expenses. Let me see what other questions we have here. Can you comment on what companies typically provide for a 401k match? Anyone want to respond to that?
Yeah, I'll talk about that a little bit, Mary. It's John Emig again. the typical, if you look at the statistics, the typical most common matching formula for 401ks these days is 50 cents on the dollar on the first 6% of employee contribution. So again, kind of using that example earlier, 6% from the employee paycheck would get 3% from the employer. We're seeing that decline. We're seeing more and more companies doing dollar for dollar on the first 4, dollar for dollar on the first 5 or 6. But, you know, if I had to say what is the most prevalent one out there right now, it is 50 cents on the dollar on the first 6 or a 3% employer contribution.
And John, this is Jenny. Just to complement that, again, the complex nature of 401ks, there is a plan type called Safe Harbor that helps reduce or eliminate from the ADP, ACT, the testing package. And so when you do that, though, the employer is required to put in that 3%. So again, it's that same 3, and there are a couple different variations, but you're getting to that. So depending on what your plan looks like, if you have low participation, so you're kind of limited how much different people can put in, and all of those things. Again, this goes back to plan design, but what I've seen, the majority of my clients really kind of gravitate towards that safe harbor plan, and the only reason sometimes they do not is that those matches, again, are required, and then they're typically immediately vested, meaning the employee itself has immediate vesting for the company match and their own deferral. And as you know, there's different ways to have the vesting schedule. And this might have been more technical, but I just wanted to follow up with John's comment and just remind the audience too that there are different ways, again, through this plan design to make sure you're fulfilling everything you'd like to.
Great, thank you, Jenny. So I want to certainly be respectful of everyone's time here. I want to remind everyone, as soon as the presentation is completed, you'll get an email with the survey question, and we'll also provide a link to the recording today. And as I said previously, we did have employers ask if they could share that with their employees to help provide some education to them, and absolutely, you can do that. If you do have questions, again, the contact information is here. The contact information will be available to you too as a follow-up, and we appreciate everyone's time today and your attention. And again, if we can help in any way, please don't hesitate to reach out to us. Thank you all so much for joining us.